Welcome to the deep dive. Today, we're taking a close look at what really makes sense when you're putting your money to work. Our source material for this exploration comes from excerpts of The Little Book of Common Sense Investing by John C. Bogle.
Yeah, and it's a classic for a reason, isn't it? It really does strip away a lot of the complexity around investing.
Yeah.
Gets right down to some fundamental, almost, well, timeless truths.
Exactly. So our mission here in this deep dive is to pull out the absolute most important nuggets of knowledge from this material, the insights that really, cut through all the noise.
Hmm.
And I think the central idea, maybe the most surprising thing we'll find, is that investment success isn't really about trying to predict the future or using super complex strategies.
No, not at all. It's fundamentally about, well, simplicity, having patience, and really, really focusing on minimizing costs. That's huge.
Okay, so let's dive into the foundation this material lays out first. It starts with a really key distinction, right, between two very different things people do with money.
That's right. It's the core split. Long-term investing versus short-term speculation.
Okay.
Investing, the way Bogle presents it, is about owning productive assets, businesses really, through stocks for the long haul. You're basically participating in their growth, their profits.
Right. You own a piece of the actual company.
Exactly. Speculation, though, that's just betting on price movements, short-term stuff, driven by sentiment, news, fads, whatever. It's not really about the business itself.
And while diversification is mentioned as important, for managing risk,
Sure, standard advice.
the source makes this really powerful central claim. It says a broad market index fund is pretty much the only investment essentially guaranteed to capture your fair share of the returns that businesses earn over time.
That guarantee, and it's a strong word, comes because the index fund is the market, or, a huge chunk of it.
It owns everything, basically.
Pretty much.
Yeah.
And capturing those business returns over time, that's where the real wealth gets built.
Hmm.
And a big part of that is, well, what the material calls the magic of compounding investment returns.
Compounding. Yeah, we hear that term a lot. But the numbers really do show the magic, don't they?
Oh, absolutely. If you could just earn, say, a 7% return each year, compounded over 5 decades, a typical working life,
Yeah.
that initial dollar wouldn't just grow by 7 cents each year. That $1 turns into 30.
$1 becomes 30
Yeah.
just from earning returns.
Precisely. And historically, the source notes, U.S. stocks have actually done even better than that in nominal terms, about 10.1% a year on average.
Wow.
It was about 6.7% after inflation, the real return. And that comes from the underlying growth, the productivity, the innovation of the businesses in the economy.
Okay, but where there's magic, there's often something working against it, right?
And in investing, that something is introduced as the tyranny of compounding investment costs.
Ah, the dark side of compounding.
Exactly. It's the flip side. Just like your returns compound and grow, so do the costs you pay. Every fee, every expense ratio, every cost from trading.
Taxes?
Taxes, absolutely. They aren't just one-off hits. That's money that's not in your account, not compounding for you. And over decades, these little costs add up. They compound into huge amounts that just, well, devour your potential returns.
Okay, so to really get why costs are such a villain, we need to understand where stock market returns actually come from. The material breaks this down really clearly into two parts.
Right. First, there's the investment return, sometimes called the enterprise return. This is the return from the actual businesses you own.
Okay.
It comes from two things: the dividends they pay out to shareholders and the growth in their earnings over time.
And the source points out something fascinating here, that corporate profit growth has tracked U.S. GDP growth almost perfectly. Like a 0.98 correlation since 1929.
Incredible, isn't it? Both averaged around 6.2%, 6.3% nominal growth per year over that super long period. So this business part, earnings growth plus dividends, that's historically been around 9% per year. That's the engine.
Okay, that's the engine. What's the second part?
The second part is the speculative return. Now, this has nothing to do with how the businesses are actually doing.
Right.
It's purely driven by changes in sentiment in how much investors as a group are willing to pay for each dollar of earnings. The price to earnings, or PE ratio. This is all about market psychology, emotion, hope, fear.
The squishy stuff, like you said.
Very squishy. And, totally unpredictable in the short term. But here's the absolute crucial takeaway. The source hammers home. While that speculative part can make prices jump around wildly day to day or year to year.
Which grabs all the headlines.
Exactly. Over the really long term, the source uses 116 years, 1900 to 2015, the total market return, about 9.5% a year on average, was almost entirely driven by that steady business part, the enterprise return. That was 9.0% of the 9.5%.
Wow, so the speculation.
The change in PE ratio over that whole century plus, it added only 0.5% per year to the total return. Almost nothing in the grand scheme.
So long-term reality is business performance. Short-term noise is just feelings.
Pretty much. And that's why, forecasting long-term business results is, well, possible. It's tied to the real economy. But forecasting short-term mood swings and PE ratios, forget it. Impossible.
Right.
The source even quotes Shakespeare on short-term market moves, sound and fury signifying nothing. You've got to focus on the real market of business, not get lost in the expectations market of stock prices.
Okay, so if the real money is made from business performance over the long haul and trying to guess short-term swings is pointless, how do you reliably capture that business return?
Oh, well, that brings us neatly to the solution presented in the material, the index fund.
The simple solution.
It's presented as the elegant, straightforward way to connect directly to that real market of business.
So what does that mean practically? How does it work?
It just means investing in a broad market index, like the S&P 500, which is, the 500 biggest U.S. companies, or even broader, a total stock market index, which holds thousands of U.S. stocks.
And do they perform similarly?
Very similarly. The source notes they have a near-perfect correlation, like 0.99, so they basically move together. Either one is a great way to own the whole U.S. market, essentially.
Got it. And the strategy itself is simple.
Deceptively simple.
Yeah.
Instead of trying to pick the few stocks or the few fund managers who might beat the market, which the source calls looking for a needle in a haystack.
Yeah, I like that analogy.
You just buy the entire haystack.
Yeah.
Own a tiny piece of every company in the index. Done.
Buy the haystack. It's memorable. And the source pulls in some big names backing this idea, right?
Oh, yeah. Heavy hitters. Warren Buffett, famously, told the trustee for his wife's estate to put 90% of the money in a low-cost S&P 500 index fund. He even mentioned Vanguard specifically.
That's a pretty strong vote of confidence.
Absolutely. From arguably the best investor ever. Then there's Nobel laureate Paul Samuelson. He had this parable about trying to find an alcoholic who could just drink moderately, basically impossible. And he told investors to forsake the search for such tiny needles.
So stop trying to find the one magic fund manager.
Right. And Jonathan Clements, a financial writer, is quoted saying picking winning funds is like trying to predict the dice. Pure chance.
And the evidence, the actual data, really backs up this buy the haystack idea.
Overwhelmingly. The source shows that index funds consistently outperform the vast majority of actively managed funds over long periods.
Like how vast?
Well, one example. The S&P 500 index itself beat 97% of actively managed large-cap funds over the 16 years from 2001 to 2016.
97%? Wow.
And that's not a fluke. The source says this superiority is across the board. It happens consistently.
And the reason why isn't some complex secret. It's just math.
It's just simple, relentless arithmetic. Think about it. The total return the market generates before any costs. That belongs to all investors combined.
Okay, the whole pie.
Right. Now, active management comes with higher fees, research costs, lots of training costs, marketing. All that stuff subtracts from the pie before it gets to the investor.
Right. Costs come out first?
Exactly. Index funds just aim to minimize those costs as much as humanly possible. So, by definition, if index fund investors pay way less in costs, they must, as a group, keep a much bigger slice of the market's return than the active investors paying all those extra costs.
Which leads us right into this idea of the loser's game. Why active management taken all together is a losing proposition for investors.
Yeah, it circles right back to that basic math. The gross market return is fixed. All investors together earn that return minus costs.
Simple as that.
Active management is just inherently more expensive. All those costs have to come from somewhere. They come directly out of the investor's return. It's unavoidable for the active manager, but it's absolutely devastating for the investor over the long term.
And the cumulative effect of those costs. The source has an example, right, that really drives it home.
It's eye-opening. It shows that if your return just lags the market by 2% a year, which is pretty typical for active funds after costs and maybe some underperformance.
Okay, 2% a year doesn't sound like that much.
Doesn't sound like much, but over 50 years. That 2% drag means costs could eat up 61% of your potential total return.
61%.
Yes, you, the investor, put up 100% of the money, you take 100% of the risk, but you end up with less than 40% of the return the market actually generated before costs.
That's incredible. Less than 40%, while the financial industry takes over 60%. It's a huge wealth transfer.
It really is. And the source quotes Justice Brandeis from way back, like a century ago, saying investors seemed obsessed with the delusion they were getting 100% of the market return. Seems like that delusion is still around.
Clearly. And it's not just index fund proponents saying this. Active managers themselves admit it.
Some of the biggest names. Peter Lynch, legendary manager of the Magellan Fund, said the public would be better off in an index fund. John Fossil, another active manager, said flat out, the average fund can never outperform the market in total.
Wow.
Even Jim Cramer, Mr. Stockpicking, admitted Bogle's arguments made him think about joining him, just because of the humble arithmetic.
So even people who played the active game successfully acknowledge that for most people, it's likely a losing bet.
And because costs are so definite, so predictable, they're actually the best predictor of future results. The source mentions Morningstar Research.
The fund rating company.
Yeah. They suggest if you could only use one thing to pick funds that might do better in the future, it wouldn't be past performance or manager skill. It would be low costs.
Low costs are the best predictor.
Seems counterintuitive, but the math holds. As Tyler Matheson is quoted, the more the managers and brokers take, the less the investors make. Simple. Profound.
Okay, beyond just the fund's performance versus the index, there's another layer here. The sources talk about this grand illusion or the investor return gap. What's that about?
This is crucial. It's the difference between the return a fund reports, its official track record.
Yeah, the number you see advertised.
Right. The difference between that number and the return the actual average investor in that fund really earns in their own account.
And there's a gap, often a big one.
Often a surprisingly big one. And it's persistent.
What causes it? Why don't investors get the fund's return?
It's mostly down to investor behavior. We tend to chase performance. It's human nature.
Buying what just went up.
Exactly. Money pours into funds after they've had a great run, often near the peak. And then when the fund inevitably hits a rough patch, investors get scared and pull their money out, often near the bottom.
Buying high and selling low. The classic mistake.
Precisely. This counterproductive timing, plus the fact that people pick funds based on past performance, which, as we'll see, doesn't predict future performance, means investors consistently underperform even the funds they invest in.
Wow. Do the sources have numbers on this gap?
They do, and they're pretty stark. Over a 25-year period studied, the average active fund reported an annual return of 7.8%, which, by the way, was already lagging the S&P 500's 9.1% return over that time.
Okay, so already behind the index.
Right. But the average investor in those active funds, because of bad timing and chasing performance, they only earned 6.3% per year.
Whoa, 7.8% reported, but only 6.3% actually earned by the investor. That's a 1.5 percentage point gap every single year.
Every year. And compound that over 25 years, the difference is huge. The source shows a $10,000 investment. In an S&P 500 index fund, it grew to about $34,500 after inflation.
Okay.
That same $10,000 invested by the average person in the average active fund suffering from that behavioral gap, it only grew to $14,400.
$34,500 versus $14,400. That's more than double the money left on the table.
Over $20,000 difference on just a $10K start, purely because of costs and bad timing driven by trying to be active. And this is another key advantage of the index fund. It removes the temptation. There's no hot manager to chase, no complex timing decisions. The strategy is just stay the course.
Just stay the course. And that's important partly because of another big idea in the sources, reversion to the mean.
RTM.
Yeah.
It's a really powerful force in finance, and especially in fund performance.
What does it mean, basically?
Simply put, things tend to revert back to average over time. So funds that have amazing performance for a few years, the winners, they tend to cool off and perform closer to the average, or sometimes even worse, in the following years.
And the losers.
The losers also tend to drift back towards the average. They might improve a bit, but rarely do they suddenly become consistent winners. Performance extremes don't usually last.
So picking a fund because it was #1 last year is probably a bad idea.
It's generally a terrible idea. The data is really compelling. One study looked at Morningstar's top-rated 5-star funds.
Yeah.
A decade later, only 14% still had 5 stars. Half of them had dropped to 3 stars or less. Performance just didn't persist.
Wow, only 14% stayed at the top.
Another analysis looked at funds divided into 5 groups, or quintiles, based on performance over a 5-year period.
Okay.
Of the funds in the top 20%, the top quintile, in one 5-year stretch, only about 13% managed to stay in that top 20% for the next 5 years.
Only 13% repeated. Where did the others go?
We'll get this. About 27% of those initial top performers actually fell all the way to the bottom 20% in the next 5 years. And another 10% were merged away or just closed down entirely.
So being a top performer was almost as likely to lead to being a bottom performer later on. That's wild.
It really shows the randomness. Nobel winner Daniel Kahneman basically said picking top funds from one period to predict future top performance is no better than chance, maybe even worse than chance.
Right.
And Nassim Taleb, author of The Black Swan, used the coin toss analogy. If someone flips 10 heads in a row, you might think they have skill. But in a large enough group of coin flippers, someone will flip 10 heads just by luck. That's what happens with fund managers. Some get lucky streaks.
It looks like skill, but it's just randomness playing out.
Exactly. So trying to pick winners based on past results is, as the source puts it, hazardous duty. Fund relative performance is largely random over time.
Okay, so given all this, the costs, the investor gap, the randomness of performance, what do the sources say about getting financial advice? Is there value there?
Yes, absolutely. But it's important to understand where the value comes from. The sources acknowledge that good financial advisors, especially registered investment advisors or RIAs, who have a legal duty to act in your best interest.
A fiduciary duty.
Right, a fiduciary duty. They can provide incredibly valuable services.
But maybe not picking winning funds.
Exactly. Their real value isn't usually in trying to beat the market by picking active funds. It's in other areas,
Yeah.
like helping you figure out the right asset allocation, the stock-bond mix, for your specific goals and how much risk you can handle.
Okay, that makes sense.
Also, navigating taxes, planning comprehensively for retirement, and maybe most importantly, behavioral coaching.
Stopping you from making those mistakes we talked about.
Precisely. Being that voice of reason when markets go crazy, helping you stick to your long-term plan, preventing you from panic selling or chasing fads, that peace of mind and discipline is hugely valuable.
But the source does seem skeptical about advisors adding value specifically through fund selection.
As a group, yes. It suggests that, on average, the funds advisors pick tend to produce average results before you even subtract the advisor's own fee.
Ouch.
And there are examples cited of broker-managed accounts underperforming, or cases where unsuitable high-fee products were pushed because of marketing, not because they were good for the client, like that Internet Strategies Fund debacle mentioned.
So the takeaway seems to be that advisors who really add value on the investment side are the ones who embrace this low-cost philosophy.
Exactly. The advisors who recommend broadly diversified, low-cost index funds are helping their clients in a huge way by minimizing those costs and improving tax efficiency. Their value isn't finding the needle. It's guiding you to the right haystack and helping you stay put.
Makes sense. Now, the sources don't just talk stocks. Bonds are the other half of the classic portfolio, right?
Absolutely. Bonds play a crucial role. They help reduce the overall ups and downs of your portfolio. They provide diversification from stocks, essential for many people.
But the return outlook for bonds isn't great either.
Likely lower than in the past, yes. The sources suggest future expected returns might be around, say, 3.1% annually, compared to historical averages that were higher, like 5.3% or even 8% in some periods.
And are bond funds subject to the same cost issues as stock funds?
Unfortunately, yes. That relentless arithmetic of costs applies just as much. Actively managed bond funds, as a group, also tend to lag their benchmarks because of costs.
Same story, different asset class.
Pretty much. Data from 2001-2016 showed active bond funds underperforming their indexes about 85% of the time across different categories. And experts who focus on bonds, like Peter Fisher or Tim Hale, are quoted supporting bond indexing for the same reasons: simplicity, low cost.
The source mentions different kinds of bond funds, maturity, quality. Any warnings there?
Yeah, a caution against chasing high yields by buying risky junk bonds. But whether you're looking at short-term, intermediate, or high-quality corporate or government bonds, the index fund approach offers the same benefits: diversification, low costs, discipline, tax efficiency.
Okay. What about ETFs? Exchange-traded funds. They're everywhere now. Friend or foe?
They can be both, really. The source makes a distinction. Broad market indexed ETFs like an S&P 500 ETF or a total stock market ETF are perfectly fine. They offer the same low-cost, diversified indexing strategy.
So if you use them like an index mutual fund.
Exactly. The danger comes when people use ETFs for frequent trading, or for betting on narrow sectors like technology or energy, or for other short-term tactical moves. The source is blunt. Betting is a loser's game.
And trading adds costs too.
Right. Brokerage commissions, maybe bid-ask spreads, and importantly, potentially higher taxes if you're constantly buying and selling and realizing gains. It all eats into your return.
What about those newer, more complex ETFs, smart beta or factor funds?
The source is pretty skeptical about those. They're often marketed as this new, better way to invest, a new paradigm, but often they're really just active strategies dressed up as indexes. They might target specific factors like value or momentum based on what worked in the past. But that means they're essentially making active bets, and they can easily fall victim to reversion to the spots. I mean, factor that was hot becomes cold.
Performance chasing again.
Kind of, yeah, and it's questionable if they're truly low cost once you account for the trading needed to maintain the factor exposure. Jim Weyant is quoted talking about how these things go in cycles, and investors just end up chasing yesterday's winner again. There's concern they can be risky for less sophisticated investors.
So the bottom line on ETFs is broad market index ETFs are good tools.
If you use them for long-term investing, just buy and hold. Don't trade them constantly. Use them for investing and not speculating.
Okay, putting this all together, asset allocation. Deciding your mix of stocks and bonds, the sources say this is huge.
Absolutely critical. The material states that asset allocation accounts for something like 94% of the differences in returns between different diversified portfolios. It's the most important decision you make.
And we've established that future returns for both stocks and bonds might be lower than we're used to.
Right, which makes every basis point, every fraction of a percent of return you keep, even more vital.
The sources mention 4 key decisions in allocation, and one is that choice between active funds and index funds.
Yes, and this is where the impact of costs leads to a really powerful, maybe even counterintuitive insight.
Okay, what's the big insight here, connecting costs and allocation?
It's this. Because high costs are such a drag on returns, a portfolio with a lower percentage in stocks, meaning less market risk, but implemented using very low-cost index funds,
Okay, lower risk.
can potentially achieve the same or maybe even a higher net return after costs than a portfolio with a higher percentage in stocks. So more risk, but burdened by the high costs of active management.
Wait, really? You could take less risk but end up with more money just by choosing low-cost funds?
Potentially, yes. The math can work out that way over the long term. The source gives an example comparing, say, a high-cost 75% stock portfolio with a low-cost 25% stock portfolio.
Yeah.
The low-cost, lower-risk option could actually win out in terms of the money in your pocket.
Wow.
It really highlights how costs fight against the risk premium you expect from stocks. As the source puts it, cost matters. Risk premium and cost penalty ever at war with each other. It completely changes how you might think about balancing risk and return. Minimizing cost is paramount.
That feels like a huge takeaway, just understanding that connection. The sources also touch on common allocation rules, like bonds equal to your age.
Yeah, the old rule of thumb. It's mentioned as a starting point, but the key is flexibility.
Yeah.
Your allocation depends on your age, yes, but also your total assets, your tolerance for risk, whether you still need income or growth.
So a younger person with decades ahead might have more in stocks.
Could be appropriate, maybe even 100% stocks, if they have a high-risk tolerance and long time horizon. The 3-fund model is also mentioned: U.S. stocks, international stocks, and bonds for global diversification.
And Social Security, how does that fit in?
It's mentioned as acting kind of like a bond in your overall financial picture, which might influence how many actual bonds you hold in your investment portfolio.
And using retirement accounts, 401k, IRAs.
Absolutely crucial for tax advantages. Roth IRAs get a mention as potentially better for new investors because withdrawals in retirement are tax-free.
What about retirement itself? Drawing income.
The advice leads towards a total return approach. Since bond yields are low, you likely can't live just off the interest. You'll probably need to spend some of the principal or capital gains too.
The 4% rule gets mentioned.
As a guideline, yeah, but again, flexibility is key. Future returns might be lower, so maybe 4% is too high for some. There are no guarantees. You have to adapt. Ben Carlson's quote, "Supporting the simple 50-40 balanced index fund," is mentioned as a solid, sensible approach.
Okay, let's try to pull all this together. What's the timeless advice, the core message distilled from these sources?
You know, it's remarkably consistent, and it echoes what investing giants have said for decades. First, focus relentlessly on the long term. Don't get caught up in the now.
Right.
Second, minimize costs, like your life depends on it, because your financial life kind of does. Third, diversify broadly. Own the whole market.
By the haystack.
By the haystack. Fourth, ignore the short-term noise, the sound and fury. It signifies nothing for your long-term plan. Fifth, absolutely give up trying to do the impossible. picking winning stocks, picking winning funds, timing the market. It's a loser's game.
And embrace simplicity.
Embrace simplicity above all else. That's the common thread.
It sounds a lot like Benjamin Graham, the father of value investing. The source quotes him, right?
Yeah, Graham advised the defensive investor to focus on diversification, stick to standard, conservative, and even unimaginative investments.
Unimaginative. I like that.
Which, as the source notes, sounds an awful lot like describing an index fund, even though they barely existed then. Graham believed getting satisfactory results is actually pretty easy. It's trying to get superior results. It's incredibly hard and usually unnecessary.
And his most famous student, Warren Buffett, basically says the same thing.
Repeatedly. Buffett says the best way for most people to own stocks, and bonds too, is through a low-cost index fund. He says it's practically guaranteed to beat the net results delivered by most investment professionals over time.
And this whole approach, low cost, discipline, simplicity, becomes even more important given the outlook for lower future returns.
Exactly. If overall market returns are likely to be lower, as firms like AQR and GMO project, then minimizing the slice taken out by costs becomes absolutely critical to your final outcome. You have less margin for error.
So stick to the basics with discipline. It's not just a nice phrase, it's essential strategy.
It really is.
Yeah.
And maybe the most powerful endorsement comes from Dr. Paul Samuelson again. He apparently compared the invention of the index fund to things like the wheel, the alphabet, even wine and cheese,
Oh, wow, that's high praise.
calling it a fundamental innovation, something essential that will stand the test of time because it's based on inescapable arithmetic.
What a journey through these ideas. We've gone from understanding where returns really come from business growth to seeing how costs and our own behavior can systematically sabotage our success.
And how this incredibly simple solution, low-cost, broad market index funds, combined with a sensible asset allocation that also considers costs, plus the discipline to stay the course, offers a reliable way to get your fair share, especially vital if future returns are indeed lower.
So let's leave you with this thought. Considering all this evidence, the power of simple arithmetic over complex predictions, how might chasing those complex, high-cost strategies feel different now? What does truly common sense investing look like for you going forward, armed with these insights?
Yeah, it definitely gives you a solid framework to think about your own approach.
It certainly does. Thank you for joining us for this deep dive.